Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of the Options Playbook, and today is Fundamental Friday. So we're going to talk about earnings a little bit more today. We've discussed quite a few trades on, well, I should say wheel trades. We've gone on the road of setting up a wheel in Apple. That trade has done very well, and then also put in a position on Netflix. Now I've gotten some requests for information just around earnings. And so we're going to talk a little bit about volatility today, just a little bit, and how we're going to try to offset it if you want to trade options around earnings. Now, this is a more speculative Fundamental Friday. And we just had, we're right in the middle of earnings season for this quarter. And last week, a lot of the mega cap tech stocks announced earnings. We had Apple, we had Amazon, both on Thursday of last week. And this week, we have a lot of industrials that are going to be announcing. And the one that we're going to focus on is Caterpillar. And we're going to look at a trade in Caterpillar. But now, before we get too far along, though, I do have to let you know that options do involve risk. And if before trading options, you should read the characteristics and risks of standardized options. It's available throughout the Tradier.com platform. And we're going to be looking at actual securities today. They're not meant to be recommendations or solicitations to buy securities. Past performance is not a guarantee of future results. All right, so let's back out and let's run over to the Tradier dashboard. And here we have it. Here's Tradier.com. This is the paper trading app. Once again, if you sign up for an account, you can paper trade right along with me on a lot of these positions. And I'm going to pull up. So in the Apple trade, what we have here is the stock is trading at 302 right now. And we have sold one of the 310 calls. So the fact that the stock has pulled back after earnings allows us an opportunity to actually either close out the short call position or potentially roll it. We also have inside this position, we have a long call option on the 250 strike call. That position, we could have taken some earnings, could have taken some profits going into earnings, and that was fine. But that would have been an opportunity to do that if we were thinking about it as far as this Apple call is concerned. And then also we had our Amazon position on, where we came in and last week we actually did a butterfly in Amazon on Options Guy TV. Now, today we're going to go down and we're going to add to a Caterpillar position, but we also got our Netflix wheel on. Here's we own 100 shares of Netflix. We actually sold the 73 strike call. We go out to August 7th on that expiration. The stock has bounced back a little bit. It's off a little bit today, but it was up around the 72 level. So we have to keep a close eye on that 73 call. If we get called away on the stock, well, then we're just going to go back to the wheel again, and we're going to sell another put. Our goal here in this instance is to end up trading around the stock positions that we have. So right now we are short one of the puts in Netflix on the 76 strike. If we get put that stock, we'd end up with 200 shares. If we get called away at 73, that would be great. Go ahead and call the stock away. But if that doesn't happen, we'd end up with 200 shares and we'd go out and sell 2 additional calls against that position. All right, now going into the earnings next week, Caterpillar's announcing earnings on Tuesday, August 3rd, and we're going to look at doing a little bit more advanced strategy. So let's pull up Caterpillar, symbol CAT, and we see the stock's at $816. Now, when you're dealing with that high of a price stock, a lot of people in the beginning trading world don't like the fact that it costs so much to buy 100 shares because it's an $816 stock. So if you're trading options and you want to get bullish on Caterpillar, which is what we're going to do there, because of the data center build outs and all the money that's all the capex that's being applied to it, Caterpillar has had a real good run up this year. Stock has pulled back a little bit. They're heading into earnings, highly anticipated because of the AI spend that they're going to have a solid earnings report. But just buying calls outright around earnings is very expensive. And the reason why is that earnings report is it brings in a lot of risk into the trade. And if you think of options as insurance, which we've talked about a lot in the pricing webinars that we have done, or I should say basic seminars. I don't know if webinar is still a term anymore, but if in those events we talked about that options are insurance products. And so if you think of, let's just think of homeowners insurance. When is your homeowner insurance the most expensive? Well, when there's a known storm, there's a hurricane that's brewing and it's starting to go towards your house. That's when it's almost impossible to buy insurance, because the risk of what's going on in the weather has increased the cost so dramatically. So in this instance, Caterpillar, that earnings report is that hurricane, and because of that, the implied volatilities go up real high. So what I want to do is kind of show you that if you go out and you look at a 35-day option contract, and you have it on an $815 stock, and you have an earnings report coming up next week, what happens to the options prices? So Caterpillar at 815, the 815 call option inside the Tradier.com platform, we see that is trading right now at $56. So if you take 56 times it by 100, that's $5,600 to buy one option contract. Now, it represents 100 shares of stock, and relative to the actual stock price, it's fairly cheap. But a 35-day option is a very popular option. Buying the at-the-money option is a very common thing to do. And then you see that implied volatility right now is up around the 50 level. Caterpillar probably trades normally at about a 24 or 25% implied volatility. But now, well, it might be up towards 30 recently with everything that's been going on in the AI space. But it's around double. It's around double what the normal implied volatility will be. And that makes this option contract really expensive. So with that said, we're going to talk about how we can offset this rise in implied volatility and some of the costs associated with trading a very high price stock. But before we do that, we're going to take a little time out here. We're going to hear a word from Tradier.
If you've been watching this show thinking, this all sounds interesting, but how do I actually start? That's where Tradier comes in. Tradier is a brokerage platform built for traders who want professional level tools without the complicated barrier to entry. As a beginner, what matters most is simplicity, reliability, and cost efficiency. Tradier gives you a clean trading interface, transparent pricing, access to stocks, ETFs, and options, and the flexibility to grow as your knowledge grows. What I like about Tradier for beginners is this. You can start small, you can learn, you can practice responsible position sizing, and you're not locked into something that won't scale with you. There's a link in the description below where you can explore Tradier and open an account when you're ready. Trade smarter, not harder. Use the right tools from day one.
All right, well, we're back. And the strategy that we're going to look at today is actually called a long call spread. So we're going to take advantage of the fact that volatilities are high, and we're going to be able to sell an option contract that wants implied volatility to come down, which has a tendency to happen after earnings, and also benefits from time decay. So instead of just buying an option outright and paying such high premium to try to participate in a bullish outlook on Caterpillar, once again, you have to be bullish on the underlying if you're going to be buying call options. An alternative to that is a long call spread. It's also referred to as a vertical spread. So I have the Caterpillar option chain, and I am going to remove that. So here's what we're going to look at. We have the 825 strike call. We're going to stay in the 35-day period. Even though we have the earnings next week, we're not going to center it just around earnings. So we're giving ourselves a little bit of time. And I don't mind going even further out if you'd like, if you want to be more longer term bullish, if we imply the long call spread strategy. Now, the downside of going further and further out is that we're going to actually be selling an option contract that we need time to decay. And obviously, it decays more rapidly on a shorter term option than on a longer term option. But here's the trade, and let's look at the profit and loss graph and talk about the strategy. So we're going to go a little bit out of the money. The stock is at $8.15 or $815. What I mean, $815. We're going to buy the 825 strike call. So now how do we do that in Tradier.com? We go to calls, we click on buy. We see that is extremely expensive. It's expensive. It has a lot to do with the cost of the underlying. And it's trading at $45 by $52. So we're going to try to look somewhere in the middle. And by doing the spread, we're going to work this order closer to the midpoint. We've talked about that before on the show. And now we're going to go out and we're trying to cut this price in half. And what I'm really going to do is just focus on how high up can I go and at least make this feasible to be able to buy this long spread. And if we do that, I'm going to go and look at a $25 because it's about half of it. And we got a fairly high probability or chance, if the market is bullish after earnings, that we could reach this strike. And I'll explain why. But we're going to look at the 880 strike. Okay. I'm going to click sell on that. And so now we're going to send these to the ticket, and that automatically populates the ticket on the bottom of the screen. We're buying the 825 strike call, selling the 880 strike call, going into the September expiration, knowing that there's earnings next week. We always like to do a limit order. So in this instance, we click on debit because we're going to be paying for it. And now we cut the price in half. We give up our opportunity to the upside, but now we're trading right around $21.85 at the midpoint. And we're going to work the order there. When you go to the trading floor with a spread order, you're buying 825, selling the 880. The midpoint is feasible. That's the kind of the wholesale price, if you will, on the spread. And around earnings, it's a very popular underlying. So getting fills or getting executed at that price, it's a little bit easier to do. The stocks are usually more liquid because a lot of people have their eyes on them because of that big pending earnings report. Now, if I hit an analysis tool over here, it shows you this is where the stock is at, and this is the profit and loss graph at expiration, which is the blue line. Now, the dotted line is referring to the profit and loss graph as of today. And this is what I want to highlight here. I'm not going to put my cursor over it because I don't want the pop-up to happen. But in this range from here to here, what it's taking into account is time decay. At expiration, you are more profitable on the trade if you blow through the top strike on your long call spread at expiration than if it happens instantly. And the main reason why is that you are selling an option contract that wants the market to go down, in theory, right? And you're buying an option contract that wants the market to go up. So to begin with, they fight with each other. This is a more in the money option contract. You're going to get rewarded more because you can buy it at 825 as opposed to 880, right? I'd rather have the ability to buy it at 825 if it's trading at 900 than buy it at 880. So you get rewarded more on the option that you buy, but you're battling the option that you sold. Now we have obviously a very wide spread, and the possibility on the upside. So our max profit is $2,523. And in this instance, our max loss is $2,970. So our profit and loss, I'd like to try to make it at least 50-50, but in this instance, we're off a little bit. I would like this to be about 2,500 and the max profit to be 2,500, but we're gonna roll with this the way it is. And this is how I would, if I'm thinking about trading Caterpillar around earnings and I have a bullish outlook, this is one alternative strategy to do as opposed to just buying the call outright and dealing with the overall cost. The width between the strikes here is we have 55 points. So we're giving ourselves a lot of room for it to run to the upside. And if I click this, I'm going to close this right now, and we're going to come back to it and enter the trade. But if I look at Delta, and we've talked about Delta in the basic videos that are put out, if you sign up for a Tradier account using the link below, we will send you out all the basic videos on that go along with Fundamental Friday. There are 4 basic videos, and in those videos we address pricing and Delta. On the chain here, we see the delta is 0.35. Now, delta is also a proxy for probability. That means that there's a 35% chance, if we're bullish, if the market perceives the earnings to be a good thing, there's a 35% chance that this option contract will finish at least 1 cent in the money on expiration, which is 35 days away. So if I look at delta, that says, well, you know what? We're obviously out of the money. We're looking for a fairly decent move in the underlying stock, but there is a chance, right? There's a 35% chance. If you think of it, when the forecast is there's a 35% chance of rain, it feels like it rains all the time when people say that. So there's a good chance that if the earnings is perceived as good, that the stock could actually reach this price. Now you go further and further out of the money, the delta gets smaller and smaller, meaning there's a lower chance, there's a lower probability. And it also affects how the option moves relative to the underlying stock price. And if you'd like to learn more, obviously sign up, get the videos, watch the videos, 4-part series on the very basics of options that are available to you. Now let's send this order down to the trading floor. It's a fairly advanced trade. So we're taking the next step where we've just talked about owning stock, selling calls against it, selling puts to buy the stock. We've talked a little bit about buying call options outright. This isn't a spot where I think I would want to buy call options outright. And now we're morphing into a little bit more advanced strategies, looking at things like spreading your risk by doing a long call spread, or also known as a vertical spread. And part of the reason why they call it a vertical spread is if you were down on the trading floor and you had to quote this trade. So we're going all the way back to the non-electronic days when everything was done on a floor and a whole bunch of people were standing in a pit, and they looked up and an order would come in, their eyes would go vertically on the quote boards. And hence that's why they call this a vertical trade. And if you did one where there were 2 different time periods, not just 35 days, let's say you did a August option and a September option, well, then your eyes would go horizontally, and that's referred to a lot as a time spread nowadays. But on the trading floor, they always called it a horizontal because of the way the quote boards were laid out. So that's where the names come from. And we have our order all set up. We're heading into that earnings report. We're going to enter our bull call spread, our vertical spread, our call debit spread. These are the names for them. If you'd like to learn more about that, you can go to optionsplaybook.com. We got all of the AKAs this trade is referred to. I think bull call spread is the most layman term that beginning option traders will use, because it's telling you that it's bullish, telling you that you're using calls, telling you that it is a spread, that it's more than one leg, which is a spread trade. And we're going to pay that net debit. Market's gone up since we've done this. 225 is the midpoint. And if I were entering this trade in the real world, not in the paper trading app, I would try to work it right at that midpoint, $22.25. I'm going to be willing to pay a little bit more because I want to get it executed. I want to make sure it gets executed before, before the noon hour, actually, is what I would prefer. So let's go 23.25. We'll give them $1. And we're going to submit this trade in the paper trading app. And here's what we're doing. We're looking at the September 4th expiration. We're going to be buying the 825 strike call. We'll be buying that to open. We're going to be selling the same expiration, 880 strike call. We'll be selling that to open. We're going to do this at a net debit to the account of $23.25. It's going to be good for the day. And boom goes the dynamite. Order has been sent. All right, let's go back and take a peek at it. I'll go back to the dashboard and we can see the order working for us. There it is. Okay, so here's our Caterpillar spread that we have all set up. And 825, 880, buying one to open, selling one to open, net debit $23.35, and this will let us know if we get filled. And if you have any questions or comments, please do put them in the chat box. We're getting close to the end here. Good morning, Kurt. Thank you for popping in and saying hello. Did you look at the Amazon trade? The Amazon trade probably did. I liked the Amazon trade, and also said we would get bearish on Apple, and Apple got beaten up today a little bit. And it's a nice problem that Apple has from what I've seen, in that they can't get enough chips because they have so much demand, and stock got beaten up. But I think it was more so about the fact that that Apple has had such a good run up. I think that's the biggest situation here, is that they have done so well. They have a tendency to sell off after earnings, after having a good quarter as far as the actual price is concerned. And then we saw a good move on Amazon. So our Amazon trade is still in there. But we'll come back on Monday and we'll talk about the advanced trades that we do in Options Guy TV. And we'll be back next Friday to look at Fundamental Friday. And we're going to go back. We have our Netflix position. We're going to have to tweak that one a little bit. We'll look at how the Caterpillar trade did, but we're going to keep this trade on for a little bit. Obviously, if the price gets cut in half or so of our spread, if the earnings were really poor or perceived as really poor, I have a feeling earnings are going to be really good, but it's all about market perception when it's all said and done. A lot of analysts are implying that they might be, but when it's all said and done, if it gets cut in half, we'll close out the position. If it continues to run, we'll look at that position and we'll evaluate, and we'll decide, should we close or maybe even roll to a higher spread if we're getting the momentum to the upside. So that's it for this edition of Fundamental Friday. We'll be back on Monday for our next edition of Options Guy TV, 11 a.m. Eastern Time. You can always find us in the hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.